An effective internal control system is also used to manage risk. Organisations use specific internal control policies and procedures to manage the risk involved with achieving business objectives. And of course, the better able an organisation is to manage risk that's in its best interest, the more value it can provide to its stakeholders. And for auditors to properly evaluate an organisation's ability to manage risk, they need to understand the organisation's internal control processes. This course begins by defining what an internal control system is. Next, it covers the process of assessing internal controls as part of creating an overall audit plan. Two major frameworks for managing risk are presented, namely the COSO framework and enterprise risk management. Finally, the course outlines the process auditors use to plan and conduct their audits within these frameworks. Auditors need to do a lot of research to plan the audit of an organisation. They need to understand the factors that could affect the organisation's financial statements. For instance, whether revenue values or assets and liabilities are accurately reported. Auditors need to understand the internal control processes that the organisation has in place to ensure that these values are accurately recorded. One of the auditor's key roles is to assess the effectiveness of these control processes. Consider this example. Jerry has been asked to audit an organisation. He begins by reviewing the existing internal control system to understand how it operates. At this early stage in planning for the audit, Jerry focuses on inventory tracking, recording of sales, and managing cash because these internal controls are relevant to his audit. Select each internal control to learn more about it. The internal control for tracking inventory is intended to ensure inventory items exist and are ready for sale. The risk is that the organisation won't be able to meet demand if inventory reported doesn't reflect actual inventory. Jerry selects a sample of the items listed in the inventory and then physically locates these specific items. Next, he speaks with third-party retailers and verifies that they have the inventory they're supposed to have. Jerry finds several instances where vendor inventory numbers don't match the organisation's numbers for the vendor. Jerry deems the related internal control ineffective and targets it for further testing during the audit. Another internal control process Gary reviews is designed to make sure all sales amounts are recorded properly and are accurate. Jerry selects items from the sales journal and collects evidence from sales invoices, shipping records, and customer purchase orders to support the items in the sales journal. Jerry finds that this internal control is working effectively and won't require further testing during the audit. As he's gathering evidence, Jerry notices that the company has excess cash in accounts that don't pay interest. Because this doesn't relate directly to the fair reporting of financial information, he won't plan this into his audit, but he does recommend the company review its internal control for managing cash and look for ways to improve it. Given the previous example, what do you think are the benefits of knowing how to identify and assess an organisation's internal controls? Internal control is a system implemented by an organisation's board of directors to provide reasonable assurance that objectives will be achieved in three categories: reliability of financial information, effectiveness and efficiency of operations, and compliance with applicable laws and regulations. An effective internal control system also helps protect assets from misappropriation or mishandling and minimise the potential for waste and loss. Each internal control system comprises individual internal controls. These are the policies and procedures that help make sure an organisation's specific goals and objectives are met. Three types of internal controls exist. Some are designed to detect errors and irregularities. Others are designed to correct errors and irregularities when they're found. Finally, some controls are designed to prevent errors and irregularities from happening. Detective, corrective and preventative controls are then designed to enable the organisation to achieve its objectives. Organisations focus on three key areas: reliability of financial information, effectiveness and efficiency of operations, and compliance with applicable laws and regulations. Select each area. Internal controls related to financial reliability may include using computer credentials or locks on filing cabinets to restrict access to information. Using pre-numbered invoices to help identify missing invoices is also an effective internal control. Internal controls can be used to promote effective and efficient operations. For instance, creating a process to help employees work more efficiently. If employees study and understand the process, it will help them save time, avoid errors, and supply higher quality products. Compliance with laws and regulations can be achieved using internal controls. An organisation may design computer software to achieve compliance objectives. The software could prompt employees to gather required information. This way, employees don't even need to know the regulations. They just have to follow the procedure and prompts outlined by the software. What does an internal control system aim to deliver? Internal controls aim to help an organisation achieve its objectives. However, all internal controls have some limitations which reduce their effectiveness. These limitations are generally caused by human error, breakdowns, and management override and collusion. The first limitation is the potential for human error. Judgment errors, carelessness, and inexperience can all diminish the effectiveness of internal controls. At times, the pressure to perform may affect people's attention to detail, leading to errors in judgment and carelessness. A lack of relevant information can also increase the potential for human error. For example, suppose an employee rushes to complete end-of-shift reports. Pressed for time, the individual assumes the data is the same as it was on previous shifts. However, this time the data highlights a new production problem that should be urgently addressed. Because the employee didn't pay attention to the new data, the issue continues to grow. The second common limitation of internal control is breakdowns in the effectiveness of controls. These breakdowns cause mistakes to happen. Breakdowns could occur because the internal controls fail to capture unusual activities and transactions. Perhaps the controls don't reflect operating conditions, specific activities, or potential new risks. Or maybe the controls are simply inadequate, making it difficult for people to follow them. For example, employees assembling a product misunderstood a poorly written procedure. This results in inconsistency in the product and its quality. The final limitation of internal controls involves management override and collusion. Both these activities involve employees working for personal gain or to advance personal motives. Select each limitation to learn more about. Management override happens when members of upper-level management choose not to follow existing policies and procedures for personal gain or advantage. For example, a manager may instruct team members to ignore an approved procedure when testing a new product. He hopes that this will ensure that it looks like the new product works, his aim being to gain support for his idea. Collusion occurs when employees work together or with individuals outside the company to bypass internal controls. Or employees may work together to alter financial data or other management information in ways that internal controls aren't designed to capture. For example, Suppose a company rewards sales agents for sales made on a quarterly basis. When possible, agents may boost their commission by overstating sales at the end of each quarter by granting future credits for unsold goods. They may even enter into side agreements with customers to achieve this. Of course, such activity will impact financial statements and therefore the reliability of financial information. In order to perform an auditor needs to understand the organisation's internal control system. The auditor can then plan and define the scope of the audit. Essentially, the auditor will want to explore internal controls of critical areas or of areas where it's believed that there's a good probability of internal controls being compromised. The auditor must first do some research in order to audit the internal control system. Previous audits can provide useful insight. Typically, auditors use them to start building an understanding of the internal control system. When researching the internal control system, auditors may also draw from their own experience, ask employees questions, or watch employees as they work. Descriptions of procedures and documentation are other good sources of information about how internal controls are working or should be working. After gaining an understanding of the internal control system, auditors use 3 steps to help them assess its effectiveness. The first step is to identify internal controls that directly impact financial statement objectives. Second, the auditor needs to assess the effectiveness of internal controls. Based on this assessment, the auditor must then determine a course of action. The first step auditors take in a financial audit is to identify controls that impact financial statement objectives. Auditors usually divide financial statement objectives into a number of categories. The ones most relevant to financial reliability are occurrence, completeness, and accuracy. Select each category. Occurrence objectives address whether transactions and events recorded have indeed taken place and relate to the organisation. For example, an occurrence objective might be to confirm sales orders only after checking the customer order, shipping document, and paid invoice for the sale. Objectives related to completeness address whether all transactions and events that should have been recorded have been recorded. An example of a completeness objective would be to check that all the invoiced amounts from sales have been recorded. Accuracy objectives address whether amounts and other data relating to recorded transactions and events have been recorded appropriately. An accuracy objective might state that transactions reported in the period must be verified by an individual independent of the recording process. During a financial audit, internal controls that don't affect the financial statement objectives shouldn't be included in the audit. For instance, controls used for decision-making processes aren't relevant to a financial audit and therefore shouldn't be included. However, in an operational audit, they would be considered. Suppose Kim, an auditor, is working to understand an internal control system. She's reviewing several individual controls to determine whether or not each one has an impact on financial statements. The first control Kim reviews is that all purchases are to be verified against receipts by someone independent of purchasing. This is an occurrence objective and is directly related to financial statements. Next, Kim reviews a sample of pre-numbered sales invoices to ensure that all of them have been accounted for. This completeness objective is related to financial statements. Kim then turns her attention to the internal controls in place to ensure the appropriate specifications of raw materials purchased. However, the internal controls in place guiding the purchase of raw materials in a manufacturing process don't impact financial statements. These represent an operational objective and therefore won't need to be planned for in the financial audit. Finally, Kim reviews the internal controls in place to ensure that excess cash held in current accounts is moved to interest-bearing accounts at the end of each day. The internal controls guiding what to do with this cash don't directly impact the financial statement objectives. This is an operational objective and doesn't need to be part of the financial audit. Nida, an auditor, is learning about a publishing company's internal control system. She needs to concentrate on internal controls that affect financial statements. She's assessing controls as part of creating her audit plan. Which internal controls should be assessed as she plans for the audit? Once internal controls have been identified, auditors need to assess them. To do so, they gather evidence to determine how well risks are managed by the internal controls in place. Auditors assess internal controls by considering whether a control's risk is at maximum or below the maximum. Select each assessment to learn more about it. When an internal control's risk is assessed as being at maximum, it indicates that the internal control is either non-existent or completely ineffective. For example, a control designed to prevent fraud would be assessed as being at maximum if evidence gathered showed fraud was occurring. An internal control's risk can be assessed as being below maximum. This indicates that the internal control is either somewhat effective or effective. For example, suppose a control designed to prevent fraud effectively manages risk by keeping the potential of the risk to acceptable levels. The control may be assessed as somewhat effective if it works, but improvements could result in it being assessed as effective. Next, auditors determine a course of action based on the assessment of internal controls. Two types of tests are performed during the audit: tests of controls and substantive tests. Select each type of tests of controls are performed on internal control procedures to evaluate their effectiveness. Substantive tests are performed on the recording of transactions themselves. They involve verifying monetary values. When auditors assess an internal control's risk as being at maximum, they make the assumption that the internal control's procedures are ineffective, meaning no tests of controls are needed. The auditors will only plan to perform substantive tests. A large amount of substantive tests will be needed because they provide the evidence of whether the financial statement's objectives are met or not. When the auditor assesses the internal control's risk as being below the maximum, it may be because enough evidence has been gathered to judge that the internal control is fully effective. In this case, no tests of controls are required, and fewer substantive tests will be required because the risks associated with the financial statement's objectives not being met are low. Typically, when the auditor has assessed an internal control's risk as being below the maximum and has gathered evidence indicating that internal control is somewhat effective, tests of controls will be performed. Depending on the outcome of these tests, the auditor will decide on the amount of substantive tests required to determine whether the financial statement's objectives are met. Consider this example. Jill, an auditor, is about to assess a company's internal controls. As she performs her assessment, she'll consider whether an internal control's risk is at maximum, below maximum and effective, or below maximum and somewhat effective. Select each. Jill spends time with upper management to gain an understanding of the risks and controls pertinent to the company. Jill notes that management doesn't demonstrate the importance of integrity or ethical values because they've failed to provide the organisation